Good afternoon, everyone, and welcome to the RealNext webinar series and our CRE market update with Dr. Jeffrey Fisher, the RealNext head of data and research. Dr. Fisher is professor emeritus from Indiana University's Kelley School of Business, co-author of Real Estate Investment and Finance and Investments in Income Property Valuation, as well as president of the Homer Hoyt Institute and consultant to NCREIF. So we are in for quite a presentation today and an interesting time. I think over the past few years, as Dr. Fisher's been presenting, it's been a continued trajectory forward and upward, and in a market that's at a trending downward slope in interest rates. And now, as we move into a higher inflationary environment and higher interest rate environment, we're going to hear how that is impacting commercial real estate markets across the country. So it seems like we might be at an inflection point in the market, and be interesting to see what the institutional investors are doing, what they're finding, and what the results have been in the first half of the year. So, Jeff, we really look forward to hearing what you have to say. As always, we will be recording this and sharing the presentation and Jeff's presentation deck, and we'll be open for questions along the way. So if you have any questions, please chime in, and I will moderate those questions either during or at the end of the session. So Jeff, you want to take it away? We will get rolling.
Okay, thank you, Jeff. I put on here back to normal, but maybe inflection point would be more appropriate. Although, as I'll show you later, the returns are kind of back to actually still slightly above a long-term average, but nothing really feels normal in the current market. It's almost a daily thing to see how the market's going to react, and especially the stock market to the events that are going on. Usually I can rely quite a bit on the end of quarter data that I get from the National Council of Real Estate and Investment Fiduciaries, but I've really scrambled this quarter to try to add information, including actually some things that just came out today to try to make this as current as possible. Again, a disclaimer, anything that I say, especially anything that sounds like a forecast, would be a personal view and not the reflection of either NCREIF or any other organization that I may have gotten slides from. I actually did the presentation a few weeks ago for the Institutional Investment Organization with somebody from Morgan Stanley, and in fact included a few of their slides in this presentation. This slide shows the total returns by asset class. So you can see, and this is end of quarter data. So if we looked at this, we might see certainly how the stock market, was down at the end of the quarter, and REITs also down quite a bit. And it's often argued that REITs lead what's going to happen in the private real estate market. So looking at this would look a little scary for what might happen in the private real estate market going forward. But then I noted down here in the red, far right bottom, that the S&P was actually, at the time I did this about 2 weeks ago, up 11%. Since then, I think it bounced down and then back again. So probably still about 11% up from the low. And the REIT index is also up about 8% since where it was the end of the quarter. So certainly things have been turning around in the stock market, nowhere near what the highs were, but it seems like the market has digested what the Fed has been doing, and hopeful that the next rate cut will only be 50 basis points, which one of the Fed chairs reminded us this morning is still high by historical standards. So he sort of hinted that at least his view was it didn't really need another 75 basis point increase, but we'll see. It's sort of a day-by-day thing, depending on what data has come out. But certainly the private real estate, indicated by the NPI index on the far left, where it says NPI research, that's NCREIF property index. Just think of that as your private real estate, private equity invested in real estate, the performance of the properties. And so, on a 1 year basis, 21%, which is really a good return by historical standards. And you see the levered return was actually 28%. A lot of that driven by industrial, as I'm sure you all know by now. But all the property types for the most part have been holding up. We'll get to that in some later slides. So I added this chart a couple weeks ago when I was doing the webinar for the institutional folks to show that, of course, the big concern has been inflation, but that has dropped off, as I'm sure you know if you've been following the news, and that's again why the market has been holding up and come off its lows, because there are signs that inflation is dropping, even though we're still at pretty high levels. We're at least off the peak and appears to be getting under control. I added some things from a research report that just came out recently from CBRE that I thought was interesting, where they're giving their opinion on what might happen to the different property types as a result of current market conditions and inflation. So multifamily, they indicate, rents have been rising 5.7% annually. The challenges that we have in the single family housing market has been good for multifamily because, the prices have gone up, and, we have affordability issues. We still have a strong labor market. So there's, still strong fundamentals for multifamily. Rent growth may be slowing though, as economic conditions weaken, but still keep hearing there's a housing shortage in this country. So a need for, both multifamily and single family. I know the rage with institutional investors, has been single family rental, although that seems to be slowing down here. And, I'd say the last month or so, where that was the hot topic for quite a while, was adding single family residential to a lot of the funds that never had single family rental properties in any of the funds before. So that was a new addition to a lot of funds. I added some comments on all of these, just short kind of one-liners in most cases, but that's in the red. Just wanted to make it clear that that wasn't what CBRE was saying. But some things I've picked up from reports that actually NCRE, group I work with, has put out, and others. So inflation is putting upward pressure on replacement costs, as well as I indicate for industrial, the higher interest rates making it a little bit more expensive to get your financing. So that is impacting supply, not only for multifamily, as I indicate here, but for all the sectors. Industrial, which has been, and think of that mainly as warehouse, although there's some other logistics in here, but gasoline prices dropping has been good for the logistics sector, as pointed out here. Although certainly gas prices are a lot higher than they were a year ago, but the continued supply chain improvement should be good for industrial and logistics. Although the worsening economic outlook may weigh on the demand for warehouse and distribution space. Actually, I look at this a little bit differently. I don't know that continued supply chain improvement is necessarily good for industrial, because to some extent, the disruptions in the supply chain has resulted in additional demand for warehouse spaces. Again, I point out in the red comments here, the phrase that I've been hearing is just in case versus what we used to say just in time. In other words, used to be that retailers and others had things worked out to a science, where they would get the inventory they needed just when they needed it to sell it, on the shelf, right before it was going to empty. But with the supply chain disruptions and not being able to know when you're going to get that inventory, you've got to have more stored in warehouse space. So it's not clear to me whether improvements in the supply chain will be good or bad. Maybe it really depends on the location and type of warehouse space. And again, new construction is being hampered by the higher construction and financing costs. For office, says prices for services rose by 5.5% year over year. More uncertain economic outlook will continue to weigh on the office market. However, leasing demand should pick up next year. We are seeing improvements in office, although institutional investors have really been reducing their allocations to the office sector. I'll show on a later chart a pie diagram of percent allocations to each sector, and that's really come down significantly for office. Still lots of questions about how many companies will continue to allow work from home. Some like Elon Musk are adamant that everybody return to the office. others. My son-in-law, I'm at my daughter's house right now. He works for Salesforce.com, and working really in another room here in the basement where I am, where it's nice and quiet, away from the grandkids. And there's been no pressure at all. And he says it's actually helped him because now he can hire people anywhere around the country. They don't have to be near a Salesforce office, since they can work from home. So it's actually allowed him to hire quality people than he was able to in the past. So I'm not sure where all that's gonna sort out. I'm sure there's opinions of several that are on the call or at least signed up that may be out there, like Norm Miller, who's done a lot of work in this area. Norm, chime in with a comment if you want, and on any of this, and Jeff will relay it to me, or anybody else that has comments, even if they're not necessarily questions. Retail continues to come under pressure as inflation erodes consumer spending. We know how prices have increased for food, although apparel dropped. As retailers, we know what's happened to Target and others that have found that they really have too much inventory and have to drop prices to get rid of that inventory. So see what's going to happen to a lot of these retailers. The institutional investors, as I note here, like the high quality open air lifestyle and power retail assets. So that's kind of where there's a lot of interest among the institutional investors. Hotels, airfares fell. You think that would be good for hotel? Um, I know it seems when places that I've traveled, it's almost impossible to get a hotel room, and rates are going up. Um, Although they indicate here that the demand may wane as you have higher prices for food and shelter, and especially for gas. Um, but I know some institutional investors are still kind of bullish on what's going to happen with hotels. And you'll see on a later slide that actually that was the one sector where returns went up this quarter, and occupancy has been increasing. So maybe seeing a turnaround in hotels. Those were, of course, one of the hardest hit sectors with the pandemic. Looking ahead, CBRE expects that inflation will subside as interest rates rise, supply chain disruptions ease. They forecast inflation will finish the year at 7.4%, but fall to 3% by year end. A lot of people think that inflation will fall off as we go into 2023, and they actually think the Fed will start lowering interest rates. That's been built into a lot of the models as we go into 2023, which of course would be good to cap rates as we talk about them later. Um, these are the top markets for investment volume, New York being the largest in terms of the dollar amount of investment. What you also see on the numbers on the far right of each bar is the year over year increase. So it was actually Houston, I think, that had the largest year over year increase in transaction volume. I need to go through each of these. Slides will be available. I just added this slide this morning. Another report from CBRE. Had a lot of good slides in the report, but this one I thought in particular was interesting, that the amount of dry powder out there is still pretty high. Dollar amount is pretty much up there at the highest it's been since 2012. As a percentage of the total size of the CR market, it's down just a little bit, but the funds have raised a lot of capital. There's a lot of capital still out there to be invested, and as you can imagine, they can't just sit on that capital very long. They have to find places for that capital to be invested. When you raise capital from investors, you can't just sit on it. Although they may not have called in all the capital, but it's been committed by the investors to put into these funds. As mentioned here, a lot of it's been raised for the more opportunistic and what we call value add funds, which are the ones that take on more risk, take on more leverage, or are willing to do repositioning of assets and do some development projects. So certainly still capital out there looking for risk on investments to put capital in. This also is from a report that just came out earlier this week from Glenn Miller, who's been doing this as far as I can remember. currently at Denver University. He does his cycle report. It's usually been sponsored by different organizations that Glenn has been involved with, more recently just done through the university. And the whole report, goes into much more detail on different CBSAs and what's happening with the property types in each of those CBSAs. I just put the national report here. I thought it was interesting. And in fact, I had some people comment to me that they were a little surprised that everything here is in that upper left green area, which means it's on the increase or peaking. Um, you can't really say how long it's going to peak, so that doesn't mean that, for example, apartments that at the very top or industrial are necessarily going to start dropping off. Although, as we'll see in some of the data, there are signs that things are slowing down a little bit, especially for industrial that's been just so hot over the past year or so. The neighborhood and community centers at the top there, those have been the subtypes of retail that have certainly been doing the best as compared to the regional malls. As you can see, the regional malls are further down, but still showing it in that upward green area. As Glenn has pointed out when he's done these presentations, property sectors don't have to necessarily move along this curve real nicely. You could go from a 8 position to a 14 position if something happens. But sort of the normal thing is to move along the curve shown here, because it's sort of driven by the cycle that we tend to see for real estate, and a lot of it's based on whether the occupancy is above or below the long-term average for that sector. You see office, maybe no surprise that it's just kind of there at the point where we think it's going to start increasing. We got downtown and suburban. Suburban has actually been doing a little bit better than the CBD office. And you see hotels right above the office, but retail above that. So kind of get the idea what's going on here. So you can see actually Glenn's email address is there. If you're interested in his report, I'm sure you could contact him and
And
find out
Jeff,
how to get it.
I think I
Yeah,
mentioned we were fortunate to have Dr. Miller agreeing to come back on with us for the to give a full in-depth market cycle report on October 6th. So look for information on that, and the full report will be presented and available during that session. So just coming up in 6 weeks or so.
great. Yeah, put that on your calendars. Thanks for reminding me that this. So what I showed you just now is a teaser, and Glenn he does a great presentation on kind of what's happening in the capital markets and the space markets, as we call it, the market for the space. So looking more at the NCREIF data from the National Council of Real Estate Investment Fiduciaries, which is properties that are held in a variety of different types of funds, well over $1 trillion in different funds. And you can see that, as I kind of hinted at the beginning of the webinar, even though returns are down, as you see at the far right, they're above that dashed line, which is the long-term average. These are quarterly returns. So see the average 2.25%. So I'm doing my math right, 9% average over the whole history of the index, which is kind of what we'd expect for real estate, I think, as a long-term return. So we're still above the average return, and we'll be talking more about this in different slides, but not sure I see anything right now that's going to push us way below the average. I wouldn't be surprised if we didn't come back down to the average, maybe slightly below, but even though I guess technically we're in a recession, it's disputed if we're really in what you could call a typical recession right now, since the labor force is so strong, consumers are still spending money. It's just that we've had some negative GDP growth. So because returns are still above average, and part of that is the increases in the value of the properties, we've actually hit a new high in market values. And actually in the next chart, I added to the one we were just looking at, the real market value index. Somebody had asked for this a couple weeks ago, and so I ended up putting it together. got me curious. What happens if you take the regular or nominal price index and deflate it each quarter by the consumer price index? You can see starting in 78, it really held steady for a long time. As we had a recession in the early 90s, it did drop below, but then got back before we had another recession there in 2008 and 2009, dropped a little bit below, but we're now at 113 relative to starting off at 100 way back in 1978. So, what that tells me is real estate, even though there's been some times when it didn't keep up with inflation for uh, the recessionary time period. Overall, real estate has kept up with inflation, but keep in mind that on top of the increase in prices, we've got our cash flow return, and real estate has always generated a nice net operating income and cash return after capex. So I think you can think of real estate as pretty much keeping up with inflation over the long term. Sometimes we say it's an inflation hedge. Whether it's an inflation hedge really means that it keeps up with unexpected changes in inflation. We're not sure if this go around, if that'll be true or not. But long run, I think it keeps up with inflation and delivers that cash flow return on top of that. So I think Jeff is geared up to pull up polling questions, and we'll see what you all think will happen to real estate values by the time we get to the end of 2022. Do you think they're going to be lower? There's going to be more recession, and the Fed's going to keep pushing rates up, and that's going to push cap rates up, and we're not going to get the increase in values, or they're going to stabilize at the current level, maybe not drop much below average, or they'll actually be somewhat higher by the end of 2022. I think you could make a case for that as well. Or you admit that you have no idea, which may be the way I'd vote.
Give everyone just a few more seconds. Looks like we're halfway home.
And I'll have you read off the results. That's a little easier than me trying to
Will do.
change things on my screen here.
All right, let's wrap it up. Most everyone's voted now. Share the results. So it looks like the values will be somewhat lower by the end of 2022, 41% and 38% feel that we're in a stabilization mode. 14% think there's an increase, and 7 are the truth tellers with no idea. But by the way, when Dr. Miller came in and said he thought the dry powder statistic was actually pretty high, which should lend itself to supporting prices more and keeping values up. So that could be a tell with that earlier slide that you had.
All right. Maybe some people will change their mind as we look at additional slides. Which direction they change it would, I guess, depend on how you interpret the slides that we're going to look at. I threw this in just to give you an idea how institutional investors are allocating funds across different sectors. And to give a little historical perspective, by the way, the hotels just kind of round to zero. There are hotels in the index, but that's just not been a focus of institutional investors because it is more of a business. It tends to be owned more by the non-institutional investors. But although I don't show the history here, what's really come down is office to be 27% when up till a few years ago, I think over pretty much the history of the index, it was 40%, which I never understood because office has never been the best performing sector, especially on a risk adjusted basis. But it was always loved by institutional investors. But what's taken over, as you see here, is industrial. Again, mostly warehouse, 31%. Of course, it's coming off a very strong performance, but that's a lot of industrial properties. This is by market value. It would be far higher percentage if we looked at it by number of properties, because as I'm sure you know, industrial properties are a lot lower price per square foot. So it takes up a lot of industrial properties being acquired to have pushed that up to 31%, and by far take the lead over the other property sectors, with office and apartment being tied at 27%, and Retail used to be much higher. It started to decline when REIT started buying a lot of other retail properties in the 90s. But of course, with the poor performance of retail that we've had in recent years, it's declined quite a bit to only 15% of institutional real estate portfolios. Returns by sector, you can see they are down for all sectors except for hotel. Hotel was up just slightly. But as I showed you earlier, even though they're down for all sectors, they're still, for the most part, at least when we combine them all together, still above average for the whole history of the index. Although, of course, some of these would be below average, especially office properties would be below average. Retail would probably be a little bit below average, and certainly industrial and apartment would be at least equal or above average. Something's got to be above average, right, for everything to be above average. And of course, a lot of that's the that strong performance of industrial properties. Again, these are quarterly returns. So you look at that industrial gray bar there, 2022 first quarter, well over a 10% return. Well over a 40% return on an annual basis. Even though it dropped to 6% for the second quarter, 24% on an annualized basis. I mean, those are just huge rates of return. So anybody that's been investing in the warehouse spaces has certainly done well. And we'll see what y'all think is going to be the better performing property sector going forward, whether it's still going to be industrial or not. This was put together by my co-presenter from Morgan Stanley, and it shows for each of these main sectors: industrial, apartment, office, and retail. What's happening here with the returns, and you can see how the year-over-year returns have actually widened. If you look at the percentiles, the 25th, you have the 25th percentile, the median, and the 75th percentile. There's more dispersion in the values of properties, especially the industrial and apartment than we've had in the past, which is kind of interesting. Office and retail, pretty much the same dispersion. In other words, we've got properties that have, you look at the industrial properties that were in the 75th percentile, 60% year-over-year returns. Even those in the lowest 25th percentile, you've got 30% year-over-year returns. So, I guess you'd feel bad if you're only in the 25th percentile, but then, who's going to argue with a 30% year-over-year return? We look at rent growth. Rent growth has really held steady. And I think that's one of the reasons, as we'll get to on a later chart, that cap rates have really held pretty steady, because even though interest rates have been going up, cap rates are affected by both, higher interest rates, but also rent growth tends to work in the opposite direction and keep cap rates down as you're willing to buy properties at a lower cap rate, expecting to get that rent growth and property value growth in the future. So we like to see rent growth holding steady. And by sector, you can see that interesting apartments really jumped up in terms of rent growth. Industrial has softened, as was pointed out by CBRE. Office held steady. Retail down just a little bit in the rent growth. So it was really apartments that came on really strong with the rent growth this quarter versus what it was last quarter. So may make some of you a little bit more bullish for the apartment sector. If we look at NOI growth, which of course is what really matters, it's actually up for the second quarter, 20222. Maybe should have put a dash in there, but it's the second quarter of 2022. these are each quarters. So you can see that the NOI growth is up. You might wonder why NOI growth went up when rent growth was holding steady. That caused me to dig into expenses more this quarter than I usually do. You'll see that here in a minute, but NOI growth by sector, you can see NOI growth up for apartments, held steady for industrial, up for office, way up for retail. So what the heck is going on there? So let's look at expenses. Expenses were up a little bit for apartment, but down, which really surprised me when I looked at this. The expense growth was actually negative. In other words, expenses went down for industrial, office, and retail this quarter. That seemed kind of odd to me, so I dug in a little bit further, and it was really utilities that were down, although maintenance a little bit down too on the industrial and retail. Not sure why the maintenance would be down on the retail, but um, I think what's probably going on there is we're just seeing that seasonality because this is second quarter into the spring more versus the winter months for the first quarter. So you'd expect that the heating costs would be down, although we do have properties that are in the certainly in the Sun Belt, but it looks like expenses um, certainly not going up near as much as rents were going up, resulted in that higher NOI growth. But I think something to keep an eye on going forward. In fact, the person from Morgan Stanley was really pointing out what's going on there with insurance. Jump back to the slide because I remembered the concern about what's happening with insurance costs, um, especially for retail. The insurance costs went up 10% last quarter and went up by over 5% for apartments. So something to keep our eye on is what's going on with the insurance costs. So what property sector do you think will perform best in the second half of 2022? Just the second half, not counting what they've already done in the first half, because industrial certainly outperformed in the first half. But um, does anybody think because we've got this big jump in rents and NOI, especially for apartments, that they'll come on and take the lead? And maybe hotels or industrial still going to keep the lead? Any brave folks for office or retail? Never know. Retail, maybe.
That expense information is particularly surprising in light of the inflation rate, that there wasn't a spike in
Yeah,
operating.
it surprised me. So you got to be careful looking at anything just on a quarterly basis because again,
Right.
you have that seasonality. So I'm going to want to dig into that on more of a long-term basis. But it will be interesting if that continues to at least not increase at the same rate as rents, which would considering what's happening with inflation. Um, that would mean, the inflation in rents is more than the inflation is impacting the expenses, which would be unusual.
So pretty large majority for apartments looking at to be the best performer, and leaving industrial in its wake this time, at least the projection with retail and hotel
That,
as
that,
outlined
that,
possible.
yeah, that's really interesting. The institutional investors still picked industrial, although apartments wasn't far behind. Um, but I don't know. I think I might go with the apartments because we do have this shortage that we keep hearing about, and we know what's happening to home prices, and um, there is some push up in the construction costs, the financing costs and construction costs, but um, we still need a lot of apartments, especially workforce
What is
housing
the
in
metric?
in
It's
this country.
about 3.8 million shortage. That's the last I
Yeah.
heard.
Um,
Units.
I think Norm, if you're on there, Norm Miller, I know you've done some research on this. If you have any comments on our shortage of housing and especially apartments, occupancy has really held steady. Actually, it crept up a little bit this quarter, so that's good. No alarm bells when we look at occupancy. Occupancy by property type. I don't see any real problems here. It's always going to be a little bit lower I don't really think of occupancy for hotels, but um, really holding up for the different property sectors. Um, pricing. Um, so we're showing cap rates here in the blue, and we've got what I like to look at is the BAA yields, because you can see that over the time period shown here, at least, um, cap rates tend to follow the BAAs quite a bit. But you've also got the 90-day treasuries. So what's interesting is um, the 90-day treasuries, of course, all interest rates are up here. So the treasuries are up and the BAAs are up. Um, but this was as of the end of the quarter. And so what I added on here um, when I did the webinar a couple of weeks ago was what it was then. And the treasuries, the short-term rates, was up even more to 2.57 from being what about 1.75. But the BAAs held steady. The long-term rate, I think, reflecting the fact that the market thinks inflation is going to get under control and come back down. So the long-term rate, even though it was up at the end of the quarter, it held steady. So um, if the long-term rate holds steady, that could be good for cap rates holding steady. Um, I suppose if it levels off at around that 5% level, you might have a little bit of an upward tick in cap rates if they're going to again kind of stay in line with the BAAs. But um, I don't think they're gonna rise at the level that the 90-day treasuries rose. So who knows? But I don't know that there's going to be a huge push up in the cap rates, but enough that most of you did think we're going to have values a little bit lower by the end of the year. Cap rates did level off this quarter. A little hard to see there, but it leveled off for this quarter. Um, hard to see because this is the whole history of the index, where as you probably know, at one time we were up around 10% cap rates, and then they just, except for the recession period, 2008, 2009, when real estate was repriced, they've been steadily dropping since then to really historical low levels for cap rates. Somebody asked me when I was doing the webinar a couple of weeks ago what happened in the early 90s. Maybe this group is a little older and remembers we had a recession that was driven by overbuilding and some tax law changes that took place kind of in the mid 80s that caught up with us in the 90s. That caused the repricing of real estate and the rise in cap rates that we had in the 90s um, until they dropped off, and were dropping pretty steadily until we had the financial crisis in 2008 and 2009. So we are really at low levels for cap rates compared to anything that we've seen historically.
Jeff, some of the
This is some.
commentary coming from the audience actually it's helpful on or it could be an answer on the expense side, thinking that with the higher occupancy, a lot of the expenses had been passed back to tenants and through the pass through, so the institutional investor was getting their cost reductions based on that transition. So not sure if that's the full
Ah,
impact.
yeah, that's a good point, because what we're seeing here is just what they have to pay. That's a good point, because this data is tracking what the institutional investors pay. Um, Now they're yeah. Uh, yeah, I guess it would have to be a net lease though, because on the where there's pass-throughs, that would show up as additional rental income, offsetting the expenses that they actually have to pay. So I think that would be part of the explanation. Yeah. Okay. Especially on the industrial space, where I think those would tend to be more the triple net leases. So interest rates, interesting here. The returns for levered properties, as you might expect, are off quite a bit, but still decent level, and we still have positive financial leverage. Um, what we also collect data on for the institutional investors is the interest that they're paying on their debt. It's not the interest rate per se, but the interest that they're paying on the debt, and we know the loan balance going into the quarter. So we can calculate what I say is the implied interest rate. Um, and some of that's going to be fixed rate debt. So it's actually kind of surprising here that you do see a significant increase in the cost of interest. Again, well, this is put on an annual basis because that's the way we're used to seeing interest rates. But so we went from a little bit over 3.4% to like 3.7%. I guess the scale makes it, you know, look like it's a bigger jump maybe than it really is, but still, um, if you're not, expecting that increase in rates and um, you go up that many basis points, that's going to eat into your, especially your levered rate of return when you're relying on that margin between what you're earning on the property and what you're paying on the debt to give you that favorable leverage. So we'll have to see what's going on with interest rates going forward. All right, cap rates by property type. Industrial took the lead in terms of the lowest cap rate, followed then by apartments, which has always had pretty low cap rates, either considered less risky on average, or another argument would be that cap rates are based on net operating income, um, whereas investors really care about their cash flow after capex, and apartments tend to have a lot less capex than the other property types. So that may also be one of the reasons why we tend to see lower cap rates for apartments. Um, you see where retail cap rates have gone up. Um, I've seen some comments recently that retail is getting to a level of cap rates which starting to become attractive again. You can see it's the highest of each of the property sectors. So, although I guess Jeff, we didn't have any. Did we have anybody vote for retail as the best performing property sector
I think that was
on
like
our
11%.
last
Yeah.
poll?
The only one that didn't was office. I think office was 0, but
Okay.
yeah.
Office getting no respect. Okay. Um, and then our return, we've been talking a lot about cap rates, but that's because the red bars in this chart are how much of our return each quarter is a result of cap rates going down. And you can see now this is annualized, so actually we saw they held steady this last quarter, so that didn't help us. But over the last year, um, you can see that it's the decline in cap rates that were really a big part of the return. So if we're not going to have further increases in cap rates, that's certainly going to eat into the return. We're going to be left with the green bars, which is our NOI growth, and the cash yield, the blue. So that still holds us at a decent level of return. Let's see, if we go up to just the top of the green bar, we're still at around actually over 9% on an annualized basis of return. We're just not going to get that extra boost from cap rates dropping. And actually, that red bar could go on the negative side, as you saw back there in 2008, 2009 period. So that could actually pull down, uh, uh, the return, as many of you expected would happen. I think our last question here is what impact do you think inflation will have on, uh, I say NPI is the NCRE property index, but just think of that as, real estate, period. What impact do you think inflation will have on real estate over the rest of the year? Is it going to reduce cap rates because we're going to have that NOI growth, and that's going to offset any impact of higher interest rates? Or we're going to have an increase in cap rates, which I'm guessing is what most of you are going to say, since you thought values were going to fall, because the Fed is going to keep, they're going to keep the war on against inflation till it, uh, cries help, and then no impact on cap rates, because those factors will offset each other, or you have no idea.
Might have a little bit of a surprise here in the results, but we'll take a look. So reduce 8% felt cap rates will actually come down based on the higher growth in rents, and
Okay.
the vast majority are feeling that increased cap rates with the higher interest
Okay.
rates.
Yeah, so that's consistent with what they said would happen to values. Um, all right. So drilling in a little bit to the subtypes, it's really a continuation of the story that we've had. If you attended past webinars, the garden apartments, it's still the COVID story, right? The less dense property sectors, whether in this case it be garden apartments versus high rise, performing better. If we go to office, the CBD has been performing better. If we go to retail, it's been the community neighborhood centers that have been doing better. Necessity-based retail doing better. And then this added by again by Morgan Stanley, I thought was interesting. So they're looking at just office and apartment in this case, and looking at the occupancy, the percent leased. Think of that as the occupancy level, inverse of vacancy, the cap rates, and then the quarterly return. And they're looking at it for the gateway cities versus the Sun Belt. Okay, so sort of the gateway markets that people tend to invest in, the main CBSAs, New York and LA and Boston and San Francisco, uh, Dallas, et cetera, DC versus just the Sun Belt cities. So look at office. So the occupancy is higher for the Sun Belt and actually holding steady where it declined for the gateway markets. The cap rates are still higher for the Sun Belt. So you're getting a higher cap rate, even though you've got higher occupancy, and the quarterly return, although it's come down, still a little bit higher, had been quite a bit higher for the Sun Belt. So kind of a case here for the Sun Belt. Let's look at apartment. Apartment, higher occupancy for the Sun Belt, higher cap rates. So you're getting a higher cap rate for investing in the Sun Belt, and the quarterly returns again down, but still quite a bit higher in the Sun Belt. So something to think about. There's certainly been a movement, whether it's COVID or politics or whatever. We've had this movement to the Sun Belt, which doesn't seem to be slowing down. So summary. Returns down, as you saw the past 2 quarters, but still above the long-term average. And that did high. Returns were down for all sectors except hotel was up slightly. Industrial was still the top performer, although certainly off the historic highs. Rent and NOI growth holding up. In fact, we saw it was really high, a big jump for apartments. Keep an eye on expenses, especially insurance, because we did see some significant increases there. And cap rates have leveled off, haven't increased so far with that rising cost of debt that I showed you. But as most of you indicated as a concern, we could see a rise in cap rates. Although I didn't sense there was a lot of panic, and not that we could tell from the polling necessarily, but that people thought we're going to see anything like we saw in past recessions. That maybe we're just in for a period of maybe some declining values and higher cap rates, but no big alarm bells going off so far. What do you think, Jeff?
No, I think you're right. I think the real estate still seems to be a favored asset class. There's money looking for it, strong yield profile and cash flow profile. With the cap rates where they are and interest rates is a little bit, well, you've got a negative arbitrage, which is a little bit of a challenge. So the financing is going to change and profile is going to change on deal structures, but it still seems like a very attractive investment for not just institutional, but private investors as well. So a lot of money still looking at real estate. And we're open for questions. Some of the questions, again, we will be sending out the deck, and we will be sending out the recording. So any of you that are looking for that and want to share it, we will be passing that along early next week. we'll get that back out to you. Dr. Miller confirmed that the shortfall in residential is in a range. I pegged it at 3.8. He said it's 3.5 to 4.3. So yeah, the 3.8 sort of midstream there. Maybe it's closer to 4. So it's still a significant shortfall of residential, and that bodes well. The other factor on the residential side, you mentioned, while it's changing a little bit, it seems that there is a floor there with the institutional investors that have the rent owned, taking a lot of property off the market, so less transient transaction than there would have been in a past cycle. So pretty interesting to have all that new capital coming into the market. I guess it's not your typical area of focus, Jeff, but the question is, how many more interest rate increases do you anticipate over the course of the next 12 to 18 months? Or maybe what do you think the end point is in interest rates?
Yeah,
3.75 to 4 is
yeah.
what
I
Fed
wish I
is.
could forecast interest rates, but I was encouraged. It was only one Fed chair, the Philadelphia Fed chair, um, that was on CBNC this morning, um, and he was saying pretty strongly, look, 50 basis points historically has been considered a big increase, um, and he kind of made it sound like he would argue for 50 basis points on the next meeting and not 75 basis points again. Um, so I think if it cuts back to 75 basis points, um, and we see continued signs of inflation dropping, I guess I wouldn't be surprised if um, there might be one more increase of 50 basis points. Um, but then, of course, it all depends on how much inflation is cut back. And there's so many exogenous things going on now that we don't know what's going to happen with the war and the slowing of China, which impacts us. What happens with oil prices and all that. But um, I'm hoping it's only 50 basis points at the next meeting. Let's put it that way.
The other thing is, and I know the Fed can't do much about it, and they have to do what they have to do, but a lot of the issue in inflation, at least it's spiking earlier in the year, was supply chain related. So it wasn't interest rate, it wasn't demand destruction related. So it was all supply chain, which uh, tends to sort itself out over time. And coming out of the pandemic, people getting back to work, factories getting back, now China opening up again, and hopefully the ports able to fulfill deliveries much more efficiently. Over time, that will work itself out, and that will relieve some of the relieve the supply side, even while demand's being slowed by inflation rates, so that or by interest rates, so that should lead to faster recovery. So I think you're right. We've got to watch and wait and see what the impact is before looking at what next year's change in interest rates would be. So we've got to look at how supply is impacted. So BTR, built to rent growth, has definitely accelerated. Are you seeing continued strong demand for absorption and acceptance by municipalities? Any comment from your institutional investors on the built to rent market, or the
Yeah,
residential
like I
rental
said
market?
earlier, that was the talk at the meetings, and uh, the organization I work with has decided to add single family rental to their index. It's never been in the index before because a lot of the funds have the single family rental. So um, there's still a lot of interest in that from institutional investors. On the other hand, I've seen some reports recently that um, there's kind of lessening interest, that we may have hit the peak in terms of the interest in that as an investment alternative. I guess it'll depend a lot on, you know, see what the performance is over the next year. And, capital chases yield. So if there's returns there, they're still going to invest in it. And I guess to some extent, well, more than, I guess to some extent, that's going to compete with the multifamily. Um,
Well, now the communities are being built for that. So it was in the past that you had a lot of inefficiencies in that built buy to rent, where you're buying lots of disparate property types and trying to manage them. Now whole communities are being built with the idea of
Right. Oh, yeah. They've got it down to a science where they have,
yeah.
yeah, they have a separate room that just, the maintenance people can get into, that has all the utilities. So it's kind of like a hotel, right, where they can come in and do everything they need to do. Well, maybe not like a hotel, but like you said, they're built in a very efficient way. All the same utilities and built in a way that they can maximize the ability to do the maintenance and economies of scale. So um,
And there's
perfect.
new investors coming in to sort of buy with a tenant in hand. So they're buying for the tenant to bridge that tenant that can't quite afford the down payment yet, but wants to move into a home. So different forms of ownership and relationship between tenant and landlord coming on the
Yeah,
residential side.
I don't know the answer to this. Maybe Norm or somebody does, and we can talk about it in a future webinar. But is there a difference in the type of person that wants to be in the single family rental versus an apartment building? Where the apartment building has other amenities, right? Whether it's clubhouses or pools or just to be able to meet girls if you're younger, right? Or meet boys.
Or you have
Um,
families when you want to move to the suburbs with your kids.
yeah. So there may be a different clientele, a different demand for each, um, which is going to affect how they're going to perform in the future. So it'd be kind of interesting.
Well, I think we've gone through the questions, you've gone through the slides, you've covered it as always, given us lots to think about and great information, Jeff. We really appreciate. We appreciate everyone taking the time to join us and chiming in through the chat. We will get this information out to you and look forward to future webinars coming. As I mentioned, we'll have the real estate market cycle index with Glenn Miller coming up in October 6th, and other real estate real next webinars in the meantime. So thank you all for joining us. Hope you all have a great afternoon. And Jeff, thank you again. Have a great day.
Thank you, Jeff. Thanks for your help.